Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So I think it's very, very important to watch this idea of debt, because I do think this is really the driver of all of it. And needless to say, we've seen the Chinese complain about the deficits. I'll get to that in a minute, because I think the Chinese are being a little duplicitous on that. But I think this is really why, for the first time, that we've seen some real concern about the reserve currency status going away. It's this idea of debt building in a very, very big way. Taylor talks about the income tax that's going to be required in order to pay off all this debt. And if you look at a potential for an income tax rate at 60% and then all the other goodies that they tax you for when you reach that level, you can see that in and of itself that would hammer away at the U.S. ability to produce wealth on the private capital side of the fence. And again, that goes to a hit against the U.S. efficiency as a global economy. So this idea of a permanent collapse in the U.S. economy tends to flow, again, out of this debt issue and all the impacts, add-on negative impact from all this debt coming into the system. We're just seeing a massive explosion in public debt, eating away at the ability or crowding out the ability for private capital to be raised in the U.S., and that creates that concern of the long-term efficiency of the U.S. economy. So you have the long-term growth aspects hit, and you have the potential for the U.S. Treasury is no longer the safest investment in the world, and this leads to that concern, obviously, of the U.S. losing its reserve currency status and other countries clamoring for other places to hide. Again, back to what Taylor had said, based on those numbers, he sees 100% inflation, 10% over 10 years would mean that the U.S. would have to pay $2.80 for a euro. The yen would be down to 50 yen per dollar, and there's that idea of gold at $2,000 an ounce. Often you see these gold bugs and a lot of the gold bulls, shall I say, using this number of $2,000 an ounce. And if you project some of these numbers that Taylor had put up, that's where this number has some plausibility and comes from. And it's obviously why the subscription for dealing with the current crisis is buy gold and sell the U.S. dollar. But again, you have to be very, very careful here, because that was the same prescription that a lot of people who even got the credit crunch right prescribed. They said buy gold and sell the dollar, but as I showed you before, once the credit crunch hit, the U.S. dollar soared in a very, very big way. And it soared in a big way because the U.S. reserve currency status and the depth of the capital markets, people had to run back and hide in the U.S. dollar. So unless we see, again, some real, stronger evidence that this reserve currency status is going away, be very, very careful about this idea that the dollar has to fall and gold has to go up in this climate. Again, very plausible, but I'm going to show you some reasons why it may not be the case. Here's a look at some of the Treasury debt. It's just this is a little bit old, but not too bad. And one of the points I wanted to make is you can see this is foreign debt held by international investors going along. And, of course, we had the stock market break in 2000. And that's when the U.S. government got very busy, and the Fed pushed interest rates down to 1%, when our investment banks, those investment banks that we used to have in New York, had actually crunched out all those derivative papers and all that dollar-based credit around the world. And there was also another factor in here. China was in a very big way, because of suppressing their currency and recycling their money back into the U.S. economy. They had to buy Treasury bonds in order to keep that game going. All of that led to this explosion in terms of debt held by foreigners, pushing that paper out there, and again, China being a continued increased buyer of U.S. Treasuries because of the symbiotic relationship they held with the U.S. Whenever they'd sell goods and they'd have these massive current account surpluses relative to the U.S., and they wanted to keep their currency pegged and low against the U.S. dollar, because the U.S. dollar is falling, the Chinese currency is falling along with it if it's pegged. And in order to maintain that peg, China was forced to buy a lot of U.S. Treasuries, and still is, in order to maintain that peg. It's just the natural result of that type of policy. So we've seen an explosion in the amount of debt held by foreigners. And the idea is, and the concern is, that one day the foreigners are going to turn around and say, hey, the U.S. dollar is falling. We're sick of holding all this paper. We're going to dump it. And when we dump it, the dollar is going to be killed. No doubt if they were to dump paper in a very, very big way all at once, the dollar would get hit very hard, and we'd probably see a massive increase, or at least a pretty big increase in U.S. Treasury yields of all the supply, coming onto the market, prices being bid down, therefore yields up. But we really are very much in that area of MAD, a mutually assured destruction, in that, China is again a very difficult balancing act with the U.S. Because they still don't have the domestic demand source in play to create the number of jobs and the growth they need for social stability. They're relying on the U.S. consumer. So for them to dump U.S. Treasuries in a big way, in some way, because of the concern of the U.S. dollar, they would really spite themselves, cut off the nose to spite their face, so to speak. So that's still in the market, and that's still a real balancing act here. So when you see these nasty scenarios, I wouldn't put too much stock into them at the moment, but what we do have to watch, if we get into some type of trade war with China, and there are signs that some trade barriers are going up in some other places because China is in a very, very big way subsidizing their companies to push out exports in a world where there is no global demand. If we see a trade war pop up and China starts to lose access to some of the Western markets, especially in the U.S., this idea of selling off treasuries to retaliate because of the fact that they can't get to the U.S. consumer anyway, then starts to come into the market and into play. But there is some counterbalancing forces that are currently going on, I think, that would denote this scenario, at least the impact in the U.S. economy. And I'll talk about that in a second. But I think, as you can see, really this idea of debt in the U.S. economy is really the driver of this negative scenario on the dollar. And I don't in any way want to, underestimate the impact of this or imply that this isn't serious or plausible. But I just think, given the shape of the global economy and the relative lead in the U.S. in terms of depth of financial markets and overall, overall efficiency of the economies in terms of the industrialized world, I don't think the situation is going to change in terms of the reserve currency status. But this is the driver. It's the debt. It's the hit to efficiency of the U.S. economy. It's the lack of capital entrepreneurs to create new jobs and new products in the U.S. longer term. It's the idea of this risk of the U.S. losing its AAA credit rating and other paper being more safe than the U.S. that's driving these concerns about reserve currency status.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.